Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is installment notes, long-term notes payable. How do we account it? So, first of all, we have difference here between the USA and the other countries. Installment payments is how we call in the US, or long-term notes payable is how we call it in international accounting, based on IFRS. They are equal amounts each period, and we have periodic reduction of the balance is sufficient at the maturity the note is completely paid. So we have no other payment at the end of our installment note or our long-term notes payable. And each payment includes both interest and principal reduction. So when we pay it, we are paying interest and we are paying the principal reduction as well. So how does it work? Go to our Excel file here. Usually we have two different types of installment notes or long-term notes payable. When we issue for cash and for other assets that is not cash. First of all, let's do our cash. And the classic one is mortgage. So Skype Corporation, my fake company, issues a $500,000, 8%, 20-year mortgage note on December 31st, 2020 that requires interest to be paid semi-annually. So what do we need to find first? Is our payments. How much we will be paying each semester, because we don't pay only the interest, we pay interest plus principal. So our total $500,000. That is on December 31st, our cash and our notes payable. So this is our first journal entry here. Period. 20 years. However, our interest to be paid semi-annually. So we need to find our numbers per semester. So our semesters, 20 years plus two semesters per year. And the interest rate is 8% divided by 2. And check your country if you are not in the US. Sometimes this interest rate here, we have different calculation. If your country considers the interest rate as simple interest, just like in the US, 8% divided by 2, or compound interest, then we have a different math. Okay? How much the payment? Equal PMT payments. If you have questions about this time value of money, we have a full playlist about time value of money. And the video about annuities, that is our payments here, it is in our video description, okay? And as well as this Excel file is also in our video description. Rate, 4%. Number of periods, 40 semester. PV, negative 500. And no FV, type nothing, because our first payment will be at the end of our first period. So our payments will be 25,271. So we need a amortization schedule here. And by the way, we have a video about amortization schedule, and it's also in our video description. So how do we do that? First semester or semester 0, our carrying value $500,000. And our payments will be 25. So let's fix this number, because our payment will be the same for the full 40 semesters. And let's double check here how much it will be. So our sum here, we will pay more than double. More than double will be interest. How do we split our interest and principal? Interest will be the carrying value times the interest rate. So here it will be $20,000. And let's copy and paste here. Nothing because we don't have the carrying value yet. And we have the sum here. And what is the principal? The principal is the difference between payments and interest. 5,271. And let's copy and paste this formula here. We have very bad numbers here because we don't have our carrying value. However, the first semester here, we have our journal entry. So notes payable, we are paying the principal. So we are reducing our notes payable. Interest expense is the interest. And cash is the payment. Notes payable, our ending balance at the end of the first semester, 494. It must be our carrying value. So it must be this number here. Let's check. How do we do our carrying value? Beginning balance less principal. And here we are having our numbers. Let's copy and paste. I don't want to copy and paste the green, so let's copy and paste now. And let's check it. Nothing. So at the end of our 40th semester, we have nothing left to pay. Total principal paid $500,000 and 510 interests. And here, if you go back to our PowerPoint, at maturity, the note is completely paid. At maturity, the note is completely paid. No ending balance here. However, what if we are working with this, but a non-cash transaction, just like this one? Scrapping Corporation purchased a package labeling machine by issuing a 12%, $1.2 million, 3-year note that requires interest to be paid semi-annually. Let's also assume that the machine could have been purchased at a cash price of $1.1 million. Here, how much we will be paying? We have no interest yet. That's bad. So, how do we do that? So, our principal here is 11 million. Or sorry, our principal is $1.2 million. Our interest, 12%, but we are paying or yes, so our interest will be 12%. And our period will be 6 years uh or sorry, 3 years or 6 semesters. Okay? And our present value here, it is, we have no idea. We need, or sorry, we have idea. It is $1.1 million. So how much will be our rate here, our effective interest rate? So let's find it. And then our machinery will be the present value, not the face value. And the note payable will be also 11 or $1.1 million here. Rate per semester. Let's do it. Formulas. Insert function. I'll call it. Whoa. Let's do it here. Rate. Number of periods, 6 semesters. Payments, negative. We don't have payments, sorry. PV, negative 1.1. FV, 1.2. We have a mistake here. Just a second, guys. Double check my problem. Oh, got it. Our interest, sorry, is not 12%. That is awful mistake. It is 1.2 times 12%. Let's do here. So it is 1.2 million times 6%. Or, as I did it earlier, 12% per year, but we are paying it per semester. So it is divided by 2. And now we have it. Now makes sense. So sorry, guys. So rate per semester, rate, number of periods, 6 semesters. PMT, how much we will be paying after each semester? Negative 72. Whoops. How much is our present value? 1.1. How much our future value? 1.2. And here we have our rate per semester. So let's go back here, this formula. So let's go to the formulas. It will be easier for you guys to see it. Rates. So our rates, number of periods, 6 semesters. PMT, how much we will be paying per semester, or how much we will be paying here. Present value, negative 1.1. Future value, oops, sorry, present value 1.1, future value negative 1.2, and type nothing. So here we have the 779. So our rate per year would be 15. But this rate per year here is not very important. So our interest rate is 779%. So instead of 6%, our effective interest rate will be 7. Why can't we use the 6? Because our asset is based on the present value instead of the future value. So that's why our interest rate now is greater. And then we move on. PMT rate 7%, number of period 6, PV negative $1.1 million. So our payments 236. So amortization schedule, carrying value 1.1. Payment will be 233 all the time. So let's copy and paste here. And our total will be more than that. Interest, carrying value times our interest rate. Let's fix it. Principal, payment less interest. So here, notes payable, and then just the same. The principal, interest 85, cash 236. And carrying value, beginning balance less principal. And let's copy and paste all of these formulas here. Wow, carrying value, ending balance, nothing. And total of interest 318, principal 1.1, notes payable. The first ending balance here must match with our first ending balance here. Okay, guys, this is not an easy topic. This is very hard topic, by the way. So watch this video anytime you want. And by the way, subscribe our channel. You will be the first one to know when a new video arrives. So thank you, guys. If you have questions or comments, leave it here or email me at scarping@gmail.com. Have a very nice day and God bless you.